Hello, welcome back. So we're taking a look at ServiceNow, another very well-known tech company that's been doing very well, and recently, as most tech companies, has been slumping a little bit, and it's actually down 25% in the last month from its recent highs of 700 actually, which is a massive difference here. So I want to see and take a look whether it's actually interesting and beneficial for us to potentially invest in this company. A company that has outstanding shares of 200 million, that's not much. But let's take a look at what's going on with the increase. And yeah, they are increasing their outstanding shares massively, really. I mean, it's almost 100% up. That's insane. Which basically means that they are printing more shares to sell to stockholders that want to get a hold of this stock and make money during that phase. Just because by issuing shares is actually a much more efficient way for companies to fund their operations. However, it's not great for investors because they're getting diluted. And this can be okay if this money is used for expansion and growth. But we can take a look at the financials and see whether that's the case at least. The interesting thing here, the current PE is at 444, which is massive, and it's projected to be 72 in the next 12 months, which is way better. It's still overpriced, but it's way better than 400, obviously. 444 is an absolutely insane PE. So let's take a look at the company's financials here, and specifically start with the income statement. And we're typically taking a look at the income statement for the last 5 years, obviously. And the nice thing about ServiceNow, which I really like, is the fact that their year-over-year growth is about the same, and it's actually high. It's 37, 30%, 32. That's a great year-over-year growth for revenues, which means that the company is actually good with selling stuff, with selling their services in this case. So that's a very positive sign for a company. And the gross profit is also growing, which means again that their operations are doing well, and that the management is doing well with cutting down on cost of revenues and increasing the actual money that stays with the company. So that's amazing to see as well. And the net income of the company went from negative to positive, and then decreased a little bit, actually, substantially, quite here in 2019. And then in 2020, in the last 12 months, it's been growing again, so not bad for sure. Let's take a look at the balance sheet. The balance sheet of the company shows a company over here, and I want to take a look at the total equity. Shows a company that's actually growing its equity, and you will see here that from 700 million, the company grew to 3.5 billion in about 4 to 5 years, really. So that's also pretty good to see. Company is actually at the market cap of $100 billion, close to that, which is a massive market cap, by the way. You have to bear that in mind, and we'll take a look at the cash flow now, see whether that's an expected market cap, or it's overbloated. So over here, the cash from operations of the company from 600 million to 2 billion. So that's really nice. I like to see companies that are actually growing their cash from operations. This is a very important metric here. And investing, the company is also investing a little bit in securities, in cash acquisitions, in capital expenditures, normal stuff here, nothing worrisome. And cash from financing, the company is actually at some years actually getting a little bit of debt, some years removing a little bit of debt, and like repaying here, and issuing a little bit of stock, as we saw, which is not great, obviously. But they also repurchase stock, which is very interesting. So when you say company repurchasing stock, this means two things basically. They want to reward investors for holding stock currently, because when that happens, your current holder's stock is getting appreciated, so it appreciates in value. And also, the company is actually thinking that the current stock price is actually undervalued based on what the company is making. This is why they are spending their hard-earned money to actually repurchase some of their common stock. And so that's, generally speaking, a very good thing, and it seems to be increasing, so I like to see that. And the most important thing, free cash flow, 400 million, 500, 900, 1.3, 1.6. So it's growing and growing nicely. I like to see that a lot. So solvency, let's take a quick peek at the debt of the company. The debt looks fine. It's a little bit of debt, but that's normal. I wouldn't be too worried over here. And cash flow of the company, we can also take a little bit of a closer look at the debt by taking a look at the liabilities of the company, the total liabilities. Let me find it here, over here. It's about 6 billion right now, the total liabilities of the company. But the company is making a cash flow of 1.3, I believe, is what we saw last year. 1.6, sorry. And so this means that the company can pay all its debt back in 3 years. That's more than good enough. And so, yeah, there's not really any worries about cash flow and debt at the moment. I wouldn't be worried about that. Now, what's going on here? We have a company that's making 1.6 billion last year, 1.3 and a billion. Let's say that 1.5 is about the average of what they're making every year in terms of free cash flow. That would bring them, if we give it a multiple of, let's give it a multiple of 30, which is an inflated multiple, that would bring them to around like 40 to 45 billion of a market cap. Right now they have double that, more than double that, at about 96 to 100. Now, yes, the company is overvalued, so I do think the company is overvalued right now. However, the current earnings are bringing the company higher after market, so you may expect to see that even more inflated when the markets open again. And so you will, if you actually want to buy the stock, you will actually be getting a 10% higher multiple price right now, and so this will actually increase the multiples over here, and generally speaking, give you a higher price. Now, I do like ServiceNow a lot. I think it's gonna progress very nicely into the future, and I'm seeing that they have some nice stuff going on for them. The problem is the current price. I mean, I'm not in love with the current price. I think it's a little bit overpriced, and this is why I don't really want to enter the company, the stock right now. I think it's a great company, and I do really like their growth, but I don't want to overpay regardless of growth. My kind of investing is the investing in which you are actually buying companies that are undervalued, and you want them to continue their operations and make money for you in the long run. I don't want to overpay for something that hasn't actually made this amount of money to actually prove that they are worth their stock price. And so I think I won't be buying ServiceNow at its current valuation. Yet I think it's a good company, and it's making good amounts of money. So if it were to go down, I doubt this will happen, because again, they kind of looks like they crashed their earnings report. And so if it were around maybe this level over here, 200, 250, I think this would be an awesome investment. And for people who bought at this level, they probably are making a killing. Obviously they are. And it's I think, generally speaking, a nice investment over at these levels. But every investment has its price. And at some point, regardless of what the investment is doing, regardless of what the company is doing, and a price for an investment can be too high. And so I don't want to get it at a high level and then worry about what's going to happen in the future, and basically lose a few years for the company to actually meet the current expected earnings based on the valuations that I bought it for. So I don't want to do that. I want to buy, again, underpriced companies if possible, or at least fairly priced. So again, ServiceNow, great company, high valuation, I wouldn't enter, but it's at least worth taking a look at the company and have it in your shortlist, see how it's gonna be doing in the future, because they seem to be growing pretty fast, and I'd like to see that. So thank you for watching the video, hope you enjoyed. If you did, you may want to join our Discord channel. I have a link in the description below this video. And if you did enjoy this one, take a look at this video that I made earlier about Amazon. See if it's worth buying now in this current market slump amid this one. So thanks for watching, and I'll see you in the next video. Bye bye.